What's happening right now in the precious metals market isn't just another cycle. It's a complete restructuring of the global financial system, and most people have no idea it's even happening. While the mainstream media focuses on stock market headlines and political theater, central banks around the world are quietly executing the largest gold accumulation in modern history. And they're doing it for a reason that should terrify anyone holding their wealth in traditional paper assets. Let me show you what I mean. Central banks have been net buyers of gold for over a decade now, but what's happening recently is unprecedented. We're seeing accumulation at levels that haven't been witnessed since the collapse of Bretton Woods. These aren't small purchases either. We're talking about hundreds of tons being added to reserves quarter after quarter, with no signs of slowing down. And here's what makes this so significant. Central banks don't speculate. They don't chase trends. When they move this aggressively into an asset, they know something the general public doesn't. The BRICS nations are leading this charge, and their strategy goes far beyond simple diversification. They're building the infrastructure for an entirely new monetary system. Brazil just made its first gold purchase in years, adding significant tonnage to its reserves. Russia and China have been accumulating relentlessly, and now we're seeing countries that traditionally held minimal gold reserves suddenly becoming major buyers. This isn't coincidence. This is coordination. But here's where it gets really interesting. The BRICS bloc now controls roughly half of the world's gold reserves. Think about that for a second. Half. And they're not stopping there. They've launched a gold-backed digital currency pilot program that's designed to facilitate trade outside the dollar system. This isn't some theoretical concept anymore. It's operational, it's being tested, and it's working. Now, you might be wondering what this has to do with your retirement account or your savings. Everything. Because what we're witnessing is the systematic dismantling of dollar dominance. And when that process accelerates, the assets you think are safe are going to be anything but. Your 401k, your pension, your savings account denominated in dollars, they're all tied to a system that's being actively replaced by the world's largest economies. Let me paint you a picture of what this looks like on the ground. Imagine you're a central banker in a country that's been holding the majority of your reserves in US Treasuries for decades. You've watched the United States weaponize the dollar through sanctions. You've seen countries cut off from the SWIFT payment system overnight. You've witnessed the Federal Reserve print trillions of dollars in response to every crisis, diluting the value of your holdings. What would you do? You'd diversify, you'd move into hard assets, you'd buy gold, and that's exactly what's happening. Quick note before we go deeper, if you're watching this and you've got retirement savings you're concerned about, I put together a free guide that breaks down the strategies thousands of American retirees are using right now to protect their wealth from exactly what we're discussing. It's in the description below. No cost, just information you need to see. Now, let's talk about the mechanics of what's actually driving this reset, because understanding the why is crucial to understanding what comes next. The global financial system has been running on a foundation of debt for decades. Government debt, corporate debt, consumer debt, all of it denominated in currencies that can be printed at will. And for a long time, that worked. As long as everyone agreed to play by the same rules, as long as the dollar remained the world's reserve currency, the game could continue. But something fundamental has shifted. The trust that held this system together is evaporating. When Russia was cut off from dollar-based systems, it sent a message to every other nation. Your reserves aren't really yours if they're held in someone else's system. That was the moment the de-dollarization movement went from theoretical to inevitable. Countries started asking themselves a very simple question. Why are we storing our wealth in an asset controlled by a foreign government that can freeze or devalue it at any time? Gold became the obvious answer. You can't print gold. You can't sanction gold. You can't freeze gold reserves held in your own vaults. It's the ultimate neutral asset. And in a world where geopolitical tensions are rising and trust in institutions is falling, neutrality has enormous value. Silver is playing a different but equally critical role in this transformation. While gold is the monetary metal, the store of value that central banks accumulate, silver is the industrial metal that's absolutely essential for the technological transition happening right now. Solar panels, electric vehicles, 5G infrastructure, military applications, medical devices, every major growth sector of the global economy is heavily dependent on silver. And here's the problem. We're running out of it. Silver mine production has been declining. Above-ground stockpiles have been drawn down to levels that would have been unthinkable a decade ago. Industrial demand is soaring, while investment demand is simultaneously increasing as people wake up to what's happening in the monetary system. This creates a supply-demand dynamic that's frankly explosive. We're talking about a market that's a fraction of the size of gold, with industrial demand that's non-negotiable, and investment demand that's just beginning to accelerate. Let me give you some context on just how tight this market has become. The amount of silver available for investment after industrial demand is satisfied is shrinking every year. Refineries are running at capacity. Delivery delays are becoming common. Premiums over spot price have been elevated for months. These are all signs of a market under stress, a market where physical metal is becoming increasingly difficult to source even as paper contracts trade freely. And that brings us to one of the most important concepts you need to understand: the difference between paper metal and physical metal. On the COMEX, the commodities exchange where gold and silver futures are traded, there are far more paper claims on metal than there is actual physical metal available for delivery. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone tries to withdraw at once. We've seen glimpses of what happens when that system gets stressed. There have been moments where the spread between paper prices and physical prices widened dramatically. Times when you couldn't buy physical metal at anywhere near the spot price because premiums spiked. These are warning signs. They're telling you that the paper market and the physical market are starting to disconnect. And when that disconnect becomes permanent, the price discovery mechanism breaks down entirely. Think about what happened in the nickel market not long ago. Trading had to be halted. Contracts had to be canceled. The entire market seized up because the paper market had diverged so far from physical reality that it became unsustainable. Now imagine that happening in gold and silver, markets that are far more important to the global financial system. The implications would be staggering. Here's what most people don't realize. The price you see quoted for gold and silver, the spot price that everyone references, is determined primarily by paper trading, futures contracts, options, ETFs that may or may not be fully backed by physical metal. The actual physical market, the market where real metal changes hands, is much smaller and much less liquid. And as more people wake up to the difference, as more investors demand physical delivery instead of paper promises, that's when the real price discovery begins. Central banks understand this perfectly. That's why they're not buying gold ETFs. They're not trading futures contracts. They're taking physical delivery and storing it in their own vaults. They're removing metal from the market permanently. And every ounce they take out of circulation is one less ounce available for everyone else. Now let's talk about what this means for the average person, for retirees, for anyone who's spent decades building up savings and planning for financial security. The traditional advice has always been to diversify across stocks, bonds, and maybe some real estate. Keep most of your wealth in the financial system, in accounts that are easy to access and manage. But that advice was built for a different era, an era when the dollar was unquestionably dominant, when the financial system was stable, when trust in institutions was high. We're not in that era anymore. The rules are changing. The system is being restructured. And the people who are going to be hurt the most are the ones who don't see it coming, who keep all their wealth and assets that are dependent on the old system continuing to function exactly as it has. I want to be clear about something. This isn't about fear-mongering. This is about pattern recognition. When you see central banks moving aggressively into gold, when you see the world's largest economies building alternative payment systems, when you see supply-demand fundamentals in critical markets reaching breaking points, these are signals. They're telling you something important is happening, and you need to pay attention. Let me take you back to a historical parallel that's incredibly relevant right now. In the early 1970s, the United States was facing a similar crisis of confidence. The dollar was under pressure. Foreign governments were losing faith in the system. And in August of 1971, President Nixon made the decision to close the gold window, ending the convertibility of dollars to gold and effectively ending the Bretton Woods system. What happened next? Gold, which had been fixed at $35 an ounce, began to float. And over the next decade, it went from $35 to over $800. That's not a 20% gain or a 50% gain. That's a 20-fold increase. And it happened because the monetary system underwent a fundamental restructuring, because the rules changed, because the old certainties no longer applied. We're in a similar moment right now. The difference is that this time, it's not just the United States making unilateral decisions. It's a multipolar world where multiple power centers are actively working to create alternatives to dollar dominance. The reset isn't coming from one country's policy decision. It's coming from a coordinated global shift in how nations store value and conduct trade. And here's what makes this moment so critical. We're still in the early stages. Most people have no idea this is happening. Mainstream financial media barely covers it. Your financial advisor probably isn't talking about it. But the smart money, the institutional money, the sovereign wealth funds and central banks, they're already positioned. They've been accumulating for years. The question is, when does the general public catch on? When does the rush for physical metal begin? Because that's when everything changes. That's when premiums explode. That's when delivery delays turn into delivery failures. That's when the paper market breaks down and the real price of these metals is revealed. And if you're trying to get positioned at that point, you're going to be competing with millions of other people who suddenly realize the same thing at the same time. Let me talk about something that doesn't get nearly enough attention: the role of industrial demand in the silver market specifically. We're in the middle of a massive technological transition. The push toward renewable energy, the electrification of transportation, the build-out of 5G and eventually 6G networks, all of this requires silver. Not wants silver, requires it. There's no substitute for silver in most of these applications. Its electrical conductivity, its thermal properties, its reflectivity, these are physical characteristics that can't be replicated by other materials. Solar panels alone are consuming hundreds of millions of ounces of silver annually, and that demand is projected to grow substantially as countries race to meet climate goals. Electric vehicles use significantly more silver than traditional vehicles. The military is a major consumer for electronics and weapon systems. Medical applications are expanding, and all of this is happening while mine production is flat to declining. This creates a situation where industrial users are competing with investors for a shrinking pool of available metal. And industrial users can't just decide not to buy if the price goes up. They need the metal to manufacture their products, so they'll pay whatever they have to pay. That puts a floor under demand that's completely independent of investment sentiment. Now combine that industrial demand floor with increasing investment demand as people wake up to the monetary reset we've been discussing. And you've got a market that's set up for a supply crisis. Not might have a supply crisis. Is set up for one. The math doesn't work. There isn't enough silver being produced to satisfy both industrial and investment demand at current prices. Something has to give. Here's where we need to talk about your personal situation, because all of this macro analysis is meaningless if you don't understand how it applies to your own financial security. If you're sitting on retirement accounts, if you've got a 401k or an IRA that's invested in traditional stocks and bonds, you need to understand that those assets are priced in dollars and dependent on the continuation of the current system. What happens to your stock portfolio if we see a major currency crisis? What happens to your bond holdings if inflation accelerates beyond the Federal Reserve's ability to control it? What happens to your purchasing power if the dollar loses its reserve currency status and foreign holders start dumping their treasury holdings? These aren't hypothetical questions anymore. These are real risks that are growing more probable by the day. And the traditional diversification strategies, the 60-40 portfolio, the balanced fund approach, they're not designed to protect you from systemic risk. They're designed to smooth out returns in a stable system. But the system isn't stable anymore. This is why more and more people are looking at precious metals not as a speculation, not as a way to get rich quick, but as insurance, as a way to preserve purchasing power through a period of monetary transition. And specifically, many are looking at gold IRAs as a way to get that protection inside their retirement accounts without triggering tax consequences. If you're sitting on $100,000 or more in retirement savings, this is something you need to understand. A gold IRA allows you to hold physical precious metals inside a tax-advantaged retirement account. You're not selling your existing investments and paying capital gains taxes. You're doing a rollover or transfer, moving funds from one qualified account to another, and instead of holding paper assets that are dependent on the financial system, you're holding physical metal that's stored in a secure depository. I put together a comprehensive guide on how this works, how to evaluate different custodians, what the fees look like, what the process involves. It's in the description below. No obligation, no sales pitch, just information you need to make an informed decision about whether this makes sense for your situation. Now, let me get back to the bigger picture, because there's another element of this reset that we need to discuss, the geopolitical dimension. What we're seeing isn't just an economic shift, it's a power shift. For decades, control of the global reserve currency gave the United States enormous geopolitical leverage. The ability to sanction countries, to control access to the international financial system, to export inflation by printing dollars that the rest of the world had to hold, these were tools of power. As that system breaks down, as alternatives emerge, that power diminishes. And the countries that have been on the receiving end of dollar-based sanctions and financial pressure, they're not just building alternatives for economic reasons. They're building them for strategic reasons. They want financial sovereignty. They want to be able to conduct trade and store wealth without being subject to another country's policy decisions. This is why the BRICS currency initiative is so significant. It's not just about creating another medium of exchange. It's about creating a parallel financial system that operates outside of Western control. And gold is the foundation of that system, because gold is the one asset that every country trusts, that has no counterparty risk, that can't be manipulated by any single nation. When you understand this geopolitical dimension, you realize that the momentum behind this reset is unstoppable. This isn't a policy that can be reversed by an election or a change in administration. This is a structural shift driven by the fundamental interests of the world's largest economies. They're not going to suddenly decide to go back to a dollar-dominated system. They're going to continue building alternatives, continue accumulating gold, continue reducing their dependence on Western financial infrastructure. And as that process continues, as more trade is conducted outside the dollar system, as more reserves are held in gold instead of treasuries, the demand for dollars decreases. And when demand for dollars decreases, while the supply continues to increase through deficit spending and Federal Reserve money printing, the value of the dollar falls. It's basic economics, supply and demand. For Americans, this is particularly important to understand because we've been insulated from currency risk for so long. We've never had to think about the value of our currency the way people in other countries do. We've taken for granted that the dollar would always be strong, always be accepted, always hold its value. But that assumption is being challenged right now. And if it breaks, the consequences for dollar-denominated assets are severe. Let me walk you through what a real currency crisis looks like, because most Americans have never experienced one. In a currency crisis, the price of everything goes up, not because things are becoming more valuable, but because your currency is becoming less valuable. Your savings lose purchasing power. Your income, even if it stays the same in nominal terms, buys less. Imported goods become expensive. Travel becomes expensive. Anything priced in other currencies becomes out of reach. And here's the insidious part. It doesn't happen all at once. It's gradual at first. Prices creep up. You notice things costing more, but it's not dramatic enough to cause alarm. Then it accelerates. The creep becomes a march. The march becomes a sprint. And by the time the general public realizes what's happening, it's too late to protect yourself because everyone is trying to do the same thing at the same time. This is why positioning matters. This is why understanding what's happening before it becomes obvious to everyone else gives you an enormous advantage. The people who protected their wealth during previous currency crises weren't the ones who waited until the crisis was undeniable. They were the ones who saw the warning signs early and acted while there was still time. And the warning signs are everywhere right now. Central bank gold buying at record levels, BRICS nations building alternative payment systems, supply-demand imbalances in critical commodity markets, debt levels that are mathematically unsustainable, geopolitical tensions rising, trust in institutions falling. These are all flashing red lights, and they're all pointing in the same direction. Now, I want to address something that I know some of you are thinking. What if I'm wrong? What if the dollar remains strong? What if the current system continues for another decade or two? What if gold and silver don't appreciate the way I'm suggesting they will? Here's my answer. Even if I'm completely wrong about the timing, even if this reset takes longer than I think it will, holding physical precious metals as part of a diversified portfolio is still sound strategy. Gold and silver have been stores of value for thousands of years. They've survived every currency collapse, every empire's fall, every financial crisis in human history. They're insurance that you hope you never need, but are grateful to have if you do. But I don't think I'm wrong about the direction. I might be wrong about the timing. These things always take longer than you expect, but the direction is clear. The momentum is building. And the longer you wait to position yourself, the more expensive that positioning becomes. Let's talk about what happens next, because understanding the sequence of events is crucial to making good decisions. We're currently in what I would call the accumulation phase. Central banks are buying, sophisticated investors are buying, but the general public is largely unaware or unconcerned. This phase can last for years, and during this phase, prices can be volatile. They can go up, they can go down. But the overall trend is higher as the smart money continues to accumulate. The next phase is the awareness phase. This is when mainstream media starts covering the story, when your neighbors start talking about gold and silver, when financial advisors who previously dismissed precious metals start recommending them. This is when prices start to move more dramatically because demand is increasing faster than supply can respond. The final phase is the panic phase. This is when everyone who ignored the warning signs suddenly realizes they need to protect their wealth. This is when premiums explode, when dealers run out of inventory, when delivery times extend from weeks to months, when the paper market breaks down because too many people are demanding physical delivery. This is when the real price discovery happens, and it's not pretty for people who waited. The question you need to ask yourself is, which phase do you want to be buying in? Do you want to be accumulating during the quiet phase when prices are reasonable and supply is available? Or do you want to be competing with millions of panicked investors during the final phase when prices have already multiplied and physical metal is scarce? I can't make that decision for you, but I can tell you that every major wealth transfer in history has followed this same pattern. The people who preserved and grew their wealth were the ones who saw the change coming and positioned themselves early. The people who lost everything were the ones who waited until the crisis was undeniable. Here's something else to consider: the opportunity cost of being wrong versus being right. If you allocate a portion of your portfolio to precious metals and I'm wrong, and the system continues as it has, what have you lost? You've held an asset that historically maintains its purchasing power. You've got insurance that you didn't need. That's not a catastrophic outcome. But if you don't allocate to precious metals, and I'm right, and we do see a major monetary reset, what have you lost? Potentially everything. Your savings, your retirement, your financial security. That's a catastrophic outcome. This is basic risk management. You don't buy fire insurance because you think your house is going to burn down. You buy it because the cost of being wrong is too high. The same logic applies here. The cost of being wrong about the monetary system is too high not to have some protection in place. Now let me address the practical question of how much. How much of your portfolio should be in precious metals? There's no one-size-fits-all answer because everyone's situation is different. Your age, your risk tolerance, your other assets, your income, all of these factors matter. But as a general principle, most experts suggest somewhere between 10 and 20% of your investable assets in precious metals as a starting point. For some people, particularly those who are more concerned about systemic risk or who are closer to retirement and can't afford to rebuild if things go wrong, that percentage might be higher. For others who are younger and have more time to recover from potential losses, it might be lower. The key is to have enough that you're protected if the worst happens, but not so much that you're overexposed to a single asset class. And within precious metals, the allocation between gold and silver is another consideration. Gold is the monetary metal, the store of value, the asset that central banks hold. It's more stable, more liquid, more widely recognized. Silver is more volatile, more industrial, more leveraged to both economic growth and monetary concerns. Many people hold both, using gold as the core holding and silver as a more speculative position with higher upside potential. The important thing is to start, to take action, to move from awareness to implementation. Because every day you wait is a day that the smart money is continuing to accumulate. Every day you wait is a day closer to the awareness phase when prices start to move more dramatically. Every day you wait is a day that your wealth remains fully exposed to the risks we've been discussing. For those of you who've made it this far in the video, who've stuck with me through this entire analysis, I want to offer you something additional. In the description below, there's a link to schedule a free one-on-one educational web conference. This is specifically for American retirees with at least $100,000 in retirement accounts. It's completely no obligation, no sales pressure, just a chance to have your specific questions answered by someone who understands these markets and can help you evaluate whether precious metals make sense for your particular situation. This offer is only available to people who mention they watched this video all the way through, so make sure you reference that when you schedule. And again, this is educational only. No one's going to pressure you to buy anything. It's just an opportunity to get personalized guidance based on your unique circumstances. Let me bring this all together, because I know I've covered a lot of ground and thrown a lot of information at you. Here's the core message. We are living through a monetary reset. The system that has been in place for decades is being restructured. Central banks know it. Sophisticated investors know it. The BRICS nations are actively building alternatives to it. And the people who are going to be hurt the most are the ones who don't see it coming.